Hello, 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 Tuesday people. Welcome. David here again. And it's another Tuesday, and welcome to your regular Tuesday video cast. My name is David Etienne of Etienne Business Solutions. And as I had advised some of you, my dear friends, last week and even earlier, that we have launched our new division, which is Etienne Strategic Management Consulting. That's a new division, Etienne Strategic Management Consulting. So we have our core services, accounting, tax, business development, etc. under Etienne Business Solutions, and we have launched a new division which is primarily focused on consulting services, and it's called Etienne Strategic Business or Strategic Management Consulting. And of course, in addition to that, I invite you to always check out my Facebook channel, YouTube channel rather, Etienne's Place. Check out Etienne's Place, where we have all the videos, presentations, maybe clips from workshops that we have done and seminars that we have done. It's all there. Good. So we're going to jump into a topic this evening, and it's one that you hear about all over the place. Employee retention tax credit. And yes, it is true. You only want to go on your search engine and type EM. You have to go no further. EM. And a flood of results come on your screen. Because so many persons, so many individuals, so many entities have been writing on this topic of employee retention tax credit. And you can understand, because, hey, man, as I said, it is really, for those who qualify, it's really a potential payday, a whopping payday, potential whopping payday. And I emphasize the word potential because, like anything else, there are rules, there are qualifiers, and sometimes, we are so anxious to get into the game and to benefit that we either inadvertently overlook some of the rules or conveniently pretend that they're not there. But anyhow, the employee retention tax credit. So today I'll just touch on a few of the, what I call the fundamentals, because as I said before, if you go online, you can read all you want about all the intricacies and the details of it and the mechanics of it. But I, as usual on this platform, I like to share with you some of the basic fundamental concepts, principles, or rules, so that you at least have an understanding, and if it is an area that you think from which you can benefit, then of course, by all means, you can do a deeper dig. So let's jump right in. Simple, like anything else. Before you can talk about benefiting from, you first need to know whether or not you qualify for. Simple, okay? So let's start with that. Basic rule of the game. COVID came and a lot of things changed. And what has happened in some instances, the government, whether it be at the federal level or at the state level, local level, whatever, have had, have seen it necessary, or had seen it necessary to pass decrees to say certain areas, certain operations, certain business entities at certain times, whatever, there was what we call a closed down order. So naturally, if your business is one that was subjected to that closed down order, then naturally you would have lost some business. So your revenues would have been impacted. So if you fall in that category where you were part of that area that was ordered to close down for a time, under the whole COVID cloud, then yes, that's one area in which you can be considered as qualifying for this benefit, for this credit. The other is Yes, you're able to continue operating and you maintain your employees during that difficult time. Okay? But naturally, your revenue stream would have been significantly impacted. It's natural. And so the rule is also saying if your revenue was impacted during this period, and we'll come into some more specifics, then you can also check whether or not you qualify under this umbrella in this category. So the employee retention tax credit and all the literature on it and the calculations, computations are essentially based around the fall in revenue. Before we jump into that aspect, the question is asked, okay, is it something that I as a business person can do myself, or I need to get a professional to do it? The simple answer, you can do it yourself if you are prepared to take on the computation, the calculations. Simple. Like anything else, you can do it yourself. You know, you may think that, okay, with a little bit of work, you can easily go through and get your numbers right. Other persons may say, boy, that's a little daunting. And for even others, they may say, I think I know how to do it. But you know what? I prefer to give it to the experts, so to speak, because they know what they're doing. And I don't want to run the risk of doing something wrong and getting into problems. So whatever the reason is, that's that. But yes, it can be done by the employer himself, or you can ask someone to do it for you. Not a problem. So let's go through it quickly now. Simple. If we're looking at that reduction in revenue as a qualifier, there are some things we need to look at specifically. Number one, 2019 is what I refer to as your base year, your anchor year, 2019. What do I mean? I mean that when you're trying to determine whether or not revenue has decreased or revenue, fell over a period of time, you need to be comparing period 1 with period 2, whatever period 1 and period 2. That is how you're going to determine if there was a fall or a reduction in revenue between period 1, period 2. Period 1 is that anchor period, that anchor year, that base year, 2019. Simple. So, you're an employer. 2019, you had your staff. That was pre-COVID. Everything was rosy-dandy. Dandy-rosy. And so you were going about your business, earning your money, paying your staff, filing your payroll returns, your quarterly returns, 941s. As I say, life was just good. Then 2020 came about and everything went topsy-turvy. So the first qualifier or the first test of whether or not you qualify is to determine whether or not your 2020 income, revenue, earnings, whatever you call it, as an employer has fallen compared to what they were in 2019. I start there. I'm going to drill down a little more. And that fall, remember now, you are comparing 2020 with 2019. In measuring that reduction in income, we say you're to look to see if your income in 2020 for any particular for a quarter compared to that related quarter in 2019, and you're going to use that comparator to determine whether or not you have a fall. So let's take, for example, Second quarter in 2019, you look at your revenue, you made $30,000. Second quarter 2019. You now want to look at the second quarter of 2020. Can I say comparable quarter? Second 2019 with second 2020. And look at your revenue and do a simple arithmetic to determine, one, whether your second quarter 2020 earnings was less than your second quarter 2019 earnings, but more than that, whether or not that fall, that reduction was 50% or more. Okay? 50% or more. Good. And so you look at your number for any quarter, or the quarter in 2019, you compare it to the similar quarter in 2020, then you can do a simple minus one number, take away the other number, or compare them, and that will tell you whether or not you have a fall, and that fall is 50% or more of what it was in 2019. That's how you do 2020. So 2020 is being compared with 2019. Assuming that when you did that computation, you find that, oh yeah, my second quarter and my third quarter of 2020 compared to the second and third quarter of 2019 shows significant fall in revenue, and those falls were, as I said, significant enough to qualify as being 50% or more reduction. You say, okay, so it looks like I can benefit from this credit for these 2 quarters in 2020. And the rule of the game is saying that look at those 2 quarters, look at the payroll, look at the salaries that you paid to each person. So you're going to look at the payroll information. And then what we call the qualifying income that you're going to use for that computation is 10,000 salary for each member of staff. So what it means is if John earned 15,000 in that quarter, say quarter 2 or quarter 3, you can only use 10,000 for the computation. If John earned $8,500 in that quarter, because you can use up to 10,000, it means that all of John's 8,500 will go into the computation. And how is the computation done? Simple. Because for that first year, and I'm calling the first year 2020, because it's the first year that you're going to use to compare with 2019, the base year. So for that first year, which is 2020, the rule of the game is saying that you are able to take 50% off the qualifying salary. The qualifying salary is 10,000, so 50% is 5,000. That's what it would be. Just using that number. Okay? When I say just use that number, just for one, I mean for one employee. Because if that employee was the one who had only $8,500 in that quarter, then it would have to be 50% of the 8,500. It cannot be 50% of more than 10,000. It must be up to 10,000. But if the guy did not earn more than 8,500, then hey, you can't just bump it up by $1,500. You have to use his salary. And so it would be either 50% of the 10,000 or 50% of any amount less than the 10,000 that the person earned. But the border, the maximum would be the 10,000. So for that first year, 2020, it is saying that you are allowed to take 50% of that 10,000, which is 5,000, and that would be what the number that you'll be using in your, as your credit for that employee. And so if you had 5 employees, 10 employees that fall in that category where they earn income and you take 10,000 maximum of each of those persons' income, find 50%. So it will always be 50% of 10,000 or 50% of a number that is less than 10,000 if the employee for that quarter earned less than 10,000. Simple. Cool. And let's move now to 2021. For 2021, the rule changed a little bit. Still using 2019 as a base year, as a year that you're going to compare to. So for 2021, still 10,000 is the qualifying income. But this time around, instead of taking only 50%, you're allowed to take 70%. So if it's at $10,000 we're using, then 70% would be $7,000. Okay? $7,000. Now also, there's a change in the qualifying percentage fall in revenue. Remember for 2020 compared to 2019, the rule said if your revenue, if your income fell by 50% or more, then you qualify. So for the 2021 rule now, it is a little less stringent, a little more lenient, so it goes down to 20%. So 20% or more. So as you can see, it's easier for you to qualify, so to speak, by virtue of number, by virtue of percentage. So in 2020, it had to be 50% or more fall in revenue compared to 2019. For 2021, it only needed to be a fall of 20% or more in revenue compared to 2019. And remember too, we're always comparing a particular quarter with the related quarter of the year in question. So this is a second quarter of 2019, then we're looking at second quarter of either 20 or 21. And that is how we determine if there was that qualifying fall in revenue between the comparable quarters, 1920 or 1921. Those are the strict rules. So once you have done that, then you say, okay, and I have 10 employees and they all qualify, so let me calculate if five qualified in 2020, then since I'm getting 5,000 per employee, then 5 of them give me 25,000. And if another 5 qualified, if I qualify in 2021 and I also have 5, no, this time is 7,000. So 7 is 35,000. And so I have 25 for 2020. I have 35 for 2021. And so we're talking about 60,000 thereabout. Using numbers, I'm just trying to bring out the principle of the thing to you. And so you've done your thing and you're ready to now do your amended 941, because that is how you're going to show. You have to do, because as I said earlier on, you'd have already maybe filed all those quarterly returns. So you now have to go back and amend them to show these credits. So you're ready to prepare your 941X. But not so fast. Not so fast. Hold your horses. Hold your horses. Do you remember a little thing called PPP? Yes. And do you remember a little thing called forgiveness of PPP? Yeah. And do you remember how happy you were when you got the PPP? Yeah. Remember how ecstatic you were when you heard and received a forgiveness? Yeah. It doesn't stop there. Do you remember that in addition to getting the PPP, free money, getting it fully forgiven, hippie hooray, you further benefit from the fact that you are still able to take it as a total write-off, salary expense on your P&L, which effectively was a write-off on your tax returns. So it was all good, 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 good. So you get benefits and benefit and benefit having to do with a certain amount of money. You got this money, which was PPP, never have to work for it. Then it was forgiven, so you'd have to pay it back. And then you were told that, yeah, you can still go ahead and use it as a normal salary expense deduction on your P&L, which would effectively be a business deduction on your business tax returns. So it was all good. Now you come to benefit from the ERTC, Employee Retention Tax Credit. But remember, the ERTC computation that we spoke about earlier on, which we are now ready to put on our 941X. Remember, that is the same salary that we had presented as justification. Maybe not all of it, but I'm saying we had presented some salary in our request for forgiveness. Salary that was paid by this PPP. And so we're saying of this quarter's 50,000, 10,000 of that was paid using PPP proceeds. And this is how you're proving to the authorities so that they can accept your request for forgiveness and provide you with the forgiveness. So you have already presented that portion of money for forgiveness of PPP. But when you do this computation for ERTC and you just pick up a quarter worth of payroll costs, those same monies are embedded in that figure again. Yeah. So what? You expect now, having received all those benefits under the PPP umbrella, to once again use the same dollars to further benefit under ERTC? Come on, man. Don't be overly greedy. Come on, man. So hear what the rule is saying. The rule is saying, once you have determined that you qualify, you do the computation, and you come up with what would be the potential amount of money that you're going to receive under the ERTC, you have to hold your brakes. You're not yet ready to put that number on your 941X. You now need to look back to see how much of that total represents PPP money that was used to pay salaries for which you had already received forgiveness, for which you had already written off, that which you had already written off on your P&L and tax returns. You have to back out that amount. Carl, you can't keep benefiting and benefiting and benefiting from the same dollar. It's almost as if you take $1 to the store and you buy something, and after you buy it, you tell the shopkeeper, give him back the dollar and use the dollar and buy something more, and you take back the dollar and you buy another thing. Come on, man, how many times are you going to spend $1? Oh, come on. So, same thing. So you can't just do the computation and just dump it on the 941X and say, hey, yes, I'm entitled to $90,000. No, you need to determine how much of that calculated total is represented by PPP money that was used to pay salary in those quarters for which you qualify. And those amounts will have to be removed, minus, subtracted, so that you do not have a triple benefit. I'm calling it a triple benefit on that same dollar. Once you have done that, then now you're ready to go to your 941. You jump on your 941X rather, and you're doing an amendment. And the form itself is pretty straightforward, straightforward, because there are a lot of things that we could adjust a 941. A lot of reasons, okay, that could cause us to want to amend a 941. And when you look at that 941X, it shows you a lot of little boxes that you could potentially check depending on what you are amending, what's the reason for your amending. And you will notice that there are boxes strictly related to the ERTC, and that is the line that you're going to put your number in, And there's also a section on the 941X that asks for explanation. Yeah, detailed explanation. How did you come up with this $85,000 that you're now putting on the 941X and expecting to receive a check for this? How did you come up with that number? And you need to be detailed in your explanation, step by step, logically, chronologically, sensibly outline how you came up with that number. So the best thing to do is to work with your little spreadsheet, step by step. So you put your 2019 income, revenue, quarter by quarter by quarter. You put your 2020 revenue quarter by quarter by quarter. You put your little column for the difference, compared quarter this with quarter that, come up with that. You say, okay, I qualify. You come up with your qualifying income for Mary, Brown, Tom, Dick. Can't be more than 10,000. So maybe 3 of them has 10, 10, 10. But the other 2 may be a 7,500 and a 6,000. You put that there. Then if you're doing it for 2020, it is 50% of those numbers. You say, okay, that times 50% is that. And when you do it for everybody, you total it up and say, oh, for 2020, I come up with a number of 30,000. Good. If it's 2021, you go through the same process. Just at this time it is 70%, and you do your thing. Then when you come to that total, you say, okay, the total potential credit is 90,000, whatever it is. However, you refer back to your payroll records and your whatever to see how much PPP money you had used as salary payment and how much you had already present as justification for forgiveness. And then you say, okay, I already benefit from this amount, can't benefit from it again. Let me know, minus it from the total calculated figure. And when you do that, now you come up with a justifiable, reasonable, Christian-like figure. Yes, man. That you can now put on the 941X. Okay? And you put your thing on the 941X and you're good to go. Let me just quickly point out that also too, naturally, just like when you were filing your 941s, you had filed them quarter by quarter by quarter. In doing these amendments, these 941Xs, it has to be that each quarter for which you qualify, you have to prepare a separate 941X. Naturally, huh? Because you're relating it to a specific quarter. And just like our 941s relates to a quarter, the 941X, which is the correction or change to that quarter, ought to be done on a quarterly basis, just as before. Okay, let me see if there's any other critical little piece that I want to say before I run away and leave you. Can't think of anything off the bat, but I would say that is the anatomy, the skeleton of this ERTC. Okay, some people say, or some of the literature say, the calculation can be extremely technical, etc. Well, I guess I won't say one way or the other. Maybe I'm not the one to say whether it is, because a lot of our business persons, employers, are not necessarily people who are into calculations and whatever. So they may find. But bottom line is that it can be done. It can be done. And the good thing about it is that you can find a lot of instructions, step-by-step instructions all over the internet. People do their thing, people create spreadsheet, people walk you through A, B, C, D and things. So you can give it a shot. But it's something that is worthwhile taking on. Whether you do it yourself or you get someone to do it for you, it is worth the while, because it is a potential whopping payday if you qualify and if you do the computation correctly. Now the question is asked, oh boy, is it possible that at some point in the future that the authorities will start auditing ERTC applications. I cannot say yes, I cannot say no, but I would say that anything, any benefit where at the time of handing out this benefit, it is based on good faith. Because remember now, you're not asked to bring a lot of documentation and bank account and whatever all that to prove anything, you know. You're just told to go through, do these calculations based on your numbers. Yes, it's true that to an extent a lot of that information is already in with the authorities, but it may not necessarily be on a quarter by quarter basis in terms of revenue streams for them to determine that, okay, he or she is speaking the truth, that third quarter of 2019 compared to third quarter of 2021 is really showing a 20% or more reduction. They will not have that level of detail. So I go back to say any kind of submission where you're benefiting, you're having some financial benefit, and it's based on a good faith submission, then yes, there's always a possibility that, you know, the authorities may say, let us do a random selection of a few individuals and just see, you know, how authentic, how true the submission are. So, will it be audited? There's nothing that says ERTC applications will be audited. No, but it is highly possible that some audit, you know, may go on. So, why do you ask? Why do you ask? Why do you ask? Okay, don't answer that question, but what I would say to you, just do the thing right. And if you feel a bit, you know, unsure, uncertain about what you're doing, it doesn't hurt. You know, get someone who is in the know, someone who provides the service and things. Some people even opt for, as a matter of fact, some providers even give you the option to go ahead, do your calculations yourself as best as you can, and then they will review it and make any corrections to it. And yes, there'll be a cost to that, but at least, you know, the cost may be less than if you went from the outset and say, hey, here's my information, go ahead and do my things and things. So that's that. So that is it for ERTC this evening. As I said before, as usual, we try to pick up the very basic, salient, important concepts, principles, rules, and present them to you so that it gets your brain working. And if you think it's something that, yeah, my company can benefit from this, and I need a little more in-depth explanation or understanding, then of course, you know, you can always check out with whether your accountant, your financial provider, your tax person, if he's that knowledgeable or so, and you know, check it out. Of course, but this is where the reservoir of all information resides. So, word to the wise, you know, word to the wise. But anyhow, thank you guys for hanging with me this evening, and as usual, stay safe, man. Stay safe. Work hard. Make a lot of money, so that down the road, when I, you know, if I should establish a non-profit and I come a begging, you guys will remember me and say, okay, hey, good boy. Let us give him a contribution towards his non-profit. But that's said and done. Happy that you were able to hang with me, and I hope for you a wonderful rest of the week. And again, we will link up next Tuesday at 8 p.m. for another video cast. And remember, check it out, subscribe, like, hit the notification button. Whatever you do, check out my YouTube channel, Etienne's Place, and be informed, but most of all, be blessed.